Oh,
Yeah,
figured it. We're good.
okay. So we started. So welcome all. Today is May 21st. I love it. This is the time where Memorial Day weekend's right around the corner. I know, always excited about Memorial Day weekend. Ever since I was a kid, it's the unofficial start of summer or the official start of summer from, the New York, New Jersey area, and we loved it. Just couldn't wait to get our feet into the sand. But typically, you ended up having to wear like a sweatshirt and a wool hat when you're on the beach, and the wind would be blowing, and you would still go in the water as a kid. And then as we get older, we get smarter. So that's just a kickoff of kind of what's the time of year that we're at. But we have our esteemed colleague, Glenn Dorsey here from Clark Capital. And instead of talking about Memorial Day weekends and summer blockbuster movies that are coming out and the cold weather, we're going to talk about the markets. Let's talk about the markets because we all love markets. So today we're going to have a conversation about the top 10, top five questions that are on most investors' minds, and then and Glenn will talk for about 15, 20 minutes, kind of covering the major pictures that are going on out there. And then we'll open it up for Q&A. While we're in the session, please put in the Q&A in the chat section, or you can email Jill or myself who are watching our emails while we're doing this. And we thank you all for attending. This is supposed to be interactive. This is to help you guys really kind of unwind from what the news, we were just having this conversation off air, what the news actually tells you and what's really happening. There's a big difference. So this today we're going to turn over to Glenn, and he's going to give you the real news that you need so you can go into Memorial Day weekend and enjoy the time with your family, put your feet in the sand, and wear that sweatshirt because I heard that it's going to be cold in New Jersey this weekend. So enjoy. So Glenn Dorsey, welcome today.
Thank you, Adam and Jill. Good afternoon, everybody. Thank you for joining. Yeah, the weather doesn't sound like it's fantastic for the weekend. I'm on Long Island, so I'll be driving through your neighborhood on the way home tonight. But it sounds like a great weekend to watch some maybe hockey playoffs and some good movies or things like that. But today I want to talk about the market. And as Adam referenced, we're bombarded with news, all of us in our business. That's our job, is to kind of filter out all of the news that's out there and try to make sense of it. And the reality is that what you see on a regular basis, you can't make sense of because because there's it's incomplete or incorrect, and it's hard to reconcile with what you see every day with in reality versus what you see on TV. So I'm going to go ahead and share my screen, walk through some slides, just so you know. You can chat. If you chat in a question, it will just go to Jill, Adam, and I, so nobody else will see it. So don't worry about whether you think it's a good question or not a good question. Uh, I'd say there's no such thing as a bad question, but that's not true. But but we do encourage that. There's a lot of news out there. I really do encourage you, if you're not sure about what you're hearing, absolutely send it in to us. So
Well, even answer a bad question, right, Glenn?
I would love that. They're the best ones, actually.
Fantastic.
All right, so. We literally do thousands of calls with advisors and clients, and we get some common questions. Geopolitics, obviously, with with what's going on in Iran, AI taking all the jobs. The Fed, which is a new Fed chair getting sworn in. Stock market continues to hit new highs. Are we in a bubble? What about the commodities? Everybody, there's always a few gold bugs on every call, so we want to talk about that. The basically the U.S. outstanding debt or debt problem and the dollar declining, is that a big issue? What do we find interesting in the market these days? What about this K-shaped recovery? The if you look at different income levels, the rich are getting richer and the poor are getting poorer, that kind of argument, and what impacts that really have. It's a midterm election year. I know, and everyone's excited about that. I couldn't be more happy to have some more politics in our lives. And then is now a good time to invest? That's a question that we get on a regular basis. People have chunks of money come in, and what should I do? The market's near a new high. Should I invest? and then my public service announcement, which is turn it off, and we'll cover that in a couple of minutes. So, geopolitics. This is 100 years of our history and 100 years of history of war. And there's never a shortage of armed conflict around the world. The blue line that kind of more or less consistently goes up and to the right is the S&P 500. Right? So the markets don't like war, and nobody does. And what you see is that these are some pretty major events: Fall of France in 1940, Pearl Harbor, Korean War. You kind of take a look at the average of these big events, and the market has about a 15% or so pullback. And then about a month after that, now we're up 9%. A year later, up 31%. So, the markets have a way of starting to get over the initial shock of what happens, and then they start to go follow the fundamentals. And we're a big believer that what drives the value of any business over time is how much money it makes. And that's really the key to being a successful investor, to focus on that. So what happened this go round? We started bombing Iran right at the end of February. We did have a pullback of about 8% in the market, and then what did it do? Started to recover again. And within it was about a 23-day period that we went down this 8%. And then within 9 days, we were higher than we were before the war. And 11 days after the March 30 low, we were actually at an new all-time high in the market again. And people have trouble reconciling, like, how's this happening? There's 20 million barrels of oil not flowing through the Strait of Hormuz, and we're going to have runaway inflation, we're going to have a recession, and how can the market be hitting new highs? The reality is that the earnings are off the charts. So first quarter earnings, which so obviously the quarter ended in March, were supposed to be up 15%, but they're up 28%. Right? That's why the market's hitting new highs, because earnings are at a new all-time high as well. I love the AI one, and I'll show you some stuff. These are the headlines from the 80s and 90s. I remember this, the tech revolution in the 90s. I was a portfolio manager, and there was all this concern that there was going to be no jobs, and that just didn't happen. Right? We actually created more jobs. We saw productivity gains, we saw earnings gains, we saw stock market do really well for a half of a decade. And then you can kind of go back by decade. In the 70s and 80s, we had the computer revolution. Those of you who are old enough know what I'm talking about. Some young people don't know what I'm talking about. This is before the PC, right? You had to get time on the mainframe to get things computed. That obviously that is over. Stenographers. When I was a Bankers Trust Company in the mid 80s. And when we would make an investment change, I would record into a cassette, and then I would bring the cassette over to a pool of people that had headphones and typewriters that would type up the investment diary on what it was. Do you think that job exists anymore? I don't think so. My first job was a paper delivery person. That job doesn't exist anymore either. Right? There's a history of these things, and you can see it by decade. In the 90s, we saw the web developers, jobs created. But think about, all right, how many jobs has this replaced in the last 20 years? Right? How'd you like to be a map maker? Right? No map makers anymore. Right? People have ways. Travel agents, everybody books everything online. All of these things that seem like you're going to have less jobs, but the reality is you end up with different jobs, right? And social media, it's just decade by decade, you can see that this is a real thing. But go back to 1970, right? This is the time period, no PCs. There were basically 80 million-ish people, 70 million people working back then. Now we have 160 million people working almost, right? So despite all of these evolutions and improvements in technology that are job disruptive, more jobs are created. Again, I thought back to my just, again, my experience, paper delivery person job gone. I used to have a job in college. I would drive to the banks and pick up all the things that were deposited that day, and I would drive it up to a processing center up by exit 10 on the Jersey Turnpike, and they would give me this big magnetic tape that looked like a movie reel, and that was the storage mechanism for all this processing. That job doesn't exist anymore either. So three jobs I've had are gone. My dad did capital budgeting for Campbell Soup Company. He'd have these massive spreadsheets on the table and a pencil, and he would add all these things up. I don't even think he had a calculator. That job's gone. My mom was a comptometer operator at Campbell Soup. That's a office scandal. That's how they met and got married in 1950. But that
What was that? Whoa, 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 wait, wait, Glenn, what was that job that your mother did?
comptometer operator, which is like a fancy calculator, as best I can explain it. I had to look it
Oh.
up because she used to tell me, and I was like, I don't know what that is. That the job doesn't exist and the machine doesn't exist anymore. But meanwhile, we have millions and millions and millions more people working. Things just evolve along the way. Um, what is the outlook and the impact of the Fed? The Fed's important. We have a new official, almost official new chair now. He's getting sworn in, I believe, tomorrow. Kevin Warsh, replacing Jerome Powell. I think the important thing, he's got a good background. The media, anybody, the media always has a field day with anything that looks political. So the head of the Federal Open Market Committee is a political appointee, so needless to say, we have politics involved with this. He was on the Fed before, and I believe he was appointed during the Obama administration. But in any event, he's got a good track record. He seems to be a pretty reasonable person in terms of what his views are, and it's not one person. The Federal Open Market Committee is made up of 12 people that vote, right? So there's the Board of Governors, which obviously he would be part of. But then you have the Federal Reserve Bank president of New York, because New York's always got a seat on the FOMC. And then you have four rotating regional bank presidents that are voters, right? So it's not a one person show. He has been fairly vocal that he thought we should have lower interest rates. That I think has been put on hold a little bit with the spike up in oil prices. What we're hoping is that he has enough sway to keep the Federal Reserve from raising rates because oil prices are higher. Because I don't know why they don't know this with how many PhDs they have there, is that monetary policy does not help higher commodity prices. We've done this over and over again where the Fed tries to raise rates because oil prices are $100 a barrel and they end up causing a recession, right? Because in and of itself, higher gas prices are a tax on the economy. I filled up the other day. I drove from Long Island to the office in Philly. I always try to get to Jersey with a pretty empty gas tank because the gas is a little cheaper there. It was at $103 to fill up. It's like, yeah, it kind of hurts a little bit. But does it hurt enough for people to change their behavior? They haven't, right? In the 70s, everybody carpooled, right? That was a thing. Like I remember my dad going to work with a bunch of people in a Ford Mustang that probably got 8 miles to the gallon. Right. That's where we are today. We're way more energy efficient. Anyway, Fed policy raising rates is a bad idea to combat higher energy prices, but hopefully he has enough sway to keep them from doing that. New Fed chairs have a history of the market challenging them, right? So if you remember Alan Greenspan, well, that picture of Alan Greenspan must be from 1960 because I don't even remember him looking that young. But what we see is this is the 6 month period before he started, right? The market was doing fine. This is when he got started, and this is the 12-month period after. Needless to say, this was the 1987. So it's kind of bad luck on his part. He didn't cause that. Ben Bernanke also had a challenging period during his first year. Janet Yellen's one of the few that didn't really have with the market down, and Jerome Powell had a couple of them along the way. So it's not uncommon for the market, as we say, to test the new Fed chair, and we'll see how that plays out. But as long as the fundamentals are good, any of this choppiness in the market tends to be very short-term oriented. As long as our businesses are making more money, and just try to remember to try to separate the stock prices and think about these as businesses. Are the businesses doing better or worse? That's what's going to determine what the stock price does over the long haul. So the Federal Reserve, we saw this whole spike up in rates when they were trying to offset the inflation from 2022, which was created by some bad government policy around COVID and dumping too much money into the system and created a lot of inflation. They were on hold for a while, and then they started to cut rates in 24 and then again in 25. And they've been going sideways. They haven't not really done anything this year. Their expectation, originally, they thought they were going to probably cut rates another time. I think that is changing. They're probably, what they're saying now is that they're likely to I would say at best they're even whether the next move is a lower rate or a higher rates. Why do we care? When the Fed is cutting rates, the market tends to do better. If the Fed's raising rates, the market tends to be a little bit more challenged. But it does matter if they're raising rates a little bit or whether they're raising rates a lot. So think about it as your brake pedal. If you just tap the brake because you don't want to, you're gaining on the car in front of you, it just slows your car down a little bit. But if you slam on the brakes, that's a whole different story. So think about that in terms of what the Fed's doing. So we can look into what's called the Fed funds futures market. And right now, there is really no expectation of a rate cut. And in fact, there is, a possibility. This is the market saying 37% chance of a quarter of a percent increase this year. This is for the December 9th Fed meeting. A couple of people out there think might even get a 0.5%. I don't think that we don't agree with that, but that's what's getting priced into the market. When we started this year in January, the market was looking for 2 to 3 cuts. Right? I have to get the word cut out of my vocabulary because the bias is shifting into potential hike mode. This is what it looks like kind of a year out in July of 2027. The biggest probability is that rates will be about a quarter of a percent higher than they are today. Again, we're not necessarily in agreement with that, and we think that they shouldn't be because, again, it's not an effective tool to raise rates to offset the effect of higher energy, but that doesn't change the fact that the Fed's done it. Now, this is a very busy chart. This is the 12 months before the Federal Reserve hikes, and this is the 24 months after, right? And what we really want to focus on is this. Okay, when the Fed's hiking rates, the first year on average, the S&P is up 4.4%. That's a mediocre, that's a less than an average return. But importantly, if the Fed's just tapping the brakes in 1 or 2 or 3 even hikes, the market's up 10.5% that next year versus if they've had multiple cuts and now we're talking about 5 cuts or excuse me, hikes. If I said cut, I meant hike. If we're having a lot of hikes and the Fed's really slamming on the brakes, that's when you see the market down, right? And that's not a good thing because it slows the economy down and likely could potentially create a recession. One thing I want to mention is not in these charts is that we're talking about this higher oil prices and inflation and the market and all this stuff is that from 2011 to 2014, oil was about $100 a barrel for a 4-year period, plus or minus $10, let's call it. Gas was $4 plus or minus. The Fed didn't hike rates. Inflation primarily stayed below 2%, and the S&P 500 was up over 60% in that 4-year period at a time. Right. So the fact that we have higher oil prices now, and we keep hearing, if it lasts longer, it's definitely going to do this. That's not what history suggests. The problems with higher energy prices have been exacerbated when the Fed raises rates. And again, 2011 and 2014, they didn't. They actually got it right. Are we in a bubble? No. We don't believe so at all. This is the earnings for the S&P 500. This is the S&P 500 price. You can see over time. I could take this chart back to the 20s, and it's the same relationship. When earnings are moving up, stock prices are following. We're hitting record high earnings. Expectations out for next year are up here, right? So as long as the earnings are supporting the stock prices going higher, that's actually a good condition. I've heard some comparisons to the technology bubble. Are we in a technology bubble? We're talking about AI, it's technology, it's driving productivity, it's driving earnings, driving the market higher. It's not like then. A couple things. So the market multiple, right? So when we're talking about that, we're talking about price, right? If you're buying a business, and don't make fun of my handwriting, it's hard to do with a mouse, and earnings. My handwriting's not good anyway. I'm not going to lie. Right. So this is if you're going to buy a business, you'd say, how much does it make? Then I'll tell you how much I'll pay. We did the same thing in the market. So back in March of 2000, we were trading at 25 times earnings. You could get a 10-year treasury that was giving you 6.2% back then. And I remember the discussion like, why are we taking all this risk in the market when you can get 6.2% risk-free, right? U.S. Treasury is considered to be risk-free, quote unquote. The important thing, right? So valuations were really high, and they're really high compared to interest rates back then. And importantly, and I talked about earnings all the time. Earnings were doing this until September of 2019, and then they did this. They went down. When did stocks peak? March of 2000, kind of right around here. It said, oh, wait, we're paying a whole lot of money for companies that are making less money. That is not a good thing. The Federal Reserve was raising interest rates pretty aggressively, and that was certainly a problem. So you had earnings declining, you had the Fed raising rates, and you had valuations that were extreme. That isn't really where we are today, right? Stocks aren't cheap, but at 20 times earnings, 21 times earnings, it still looks good relative to a 4.4% treasury, right? You're still getting rewarded for taking a little bit of risk. We've been in a good market. We call this bull market started here in October of 2022, and all these squiggly lines are prior bull markets. How much did they go up? How long did they last? All of that stuff. So when you look at where we are today in this bull market, or as of March 19th, it's May 19th, that's pretty close. Um, this is not an old bull market. This hasn't been going on for that long, and it's not up at extreme levels, right? Relative to history. When you look at, from end of 87 to almost 2000, you had a 3,200 day period of time where the market was up almost 600%. That's a long bull market. And then we always say they end the same way, and that's usually when earnings collapse and the Fed starts to raise rates aggressively. But this is the earnings outlook, right? Earnings were projected for 2027, almost $400 a share. End of this year, 336. I mean, look at the growth that we're having. Remember 2022, how much fun that was? Earnings went down. Right? That's a problem when earnings go down and interest rates were moving up. Not a good combination, but that's not what we have right now.
Hey,
And
Glenn,
what
can you go back to that last chart and just remind people? Well, obviously, looking at the chart, 2020, we know why earnings went down. COVID, right?
right.
So what was 2022? What was the main driver that you could recall for that year?
Remember we had runaway inflation, right? We had sudden inflation. And the reason we had inflation, if you think about it, we were in a period we were not back to full production because of COVID. Companies were having trouble getting people back to work and making things. And the government had dumped $1 trillion+ into the economy with their stimmy checks, and people had a lot of money to spend, and we weren't making very much. So we had inflation that just took off. By the way, gas was over $5 a gallon in 2022. Nobody mentions that now, right? So companies had a lot of shipping costs that went up a lot. A lot of expenses to run the business were higher, right? At a time that the economy still hadn't fully recovered yet.
And that was a year recalling, and again for our clients and for just all of us, that was a year where, it didn't really matter where we couldn't hide. Stocks went down, but that was the year that bonds went down too. It was the year that all of a sudden bond returns were negative for the end of the year, and we're like, what happened here?
They were negative in an order of magnitude that had never been seen in history. Prior to 2022, the worst year for the bond market, I think it was down minus 2.7%. It was down 13% in 2022. So you had a spike up in interest rates, you had a spike in inflation, you had disrupted demand and supply and shipping and all kinds of bad things were happening. The reality is earnings didn't go down that much, right?
Right.
But that those higher interest rates wanted, what that makes people want to pay less for the earnings. And again, we focus on earnings all the time. This is the S&P 500 for 2024. This is the earnings for 2025. These are the estimates over time. So what we saw is that estimates were going down, and then all of a sudden they were going up. So that, this is where the market is now for 2026. The red line is just kind of projecting 12 months forward. So this would project out to the first quarter of 2027. That's a pretty good uptrend there. And here's what the earnings estimates have done for 27. This is the normal pattern. The estimates come out, analysts are excited, and as the year progresses, the numbers go down. We're seeing the opposite. The companies that are coming and reporting are absolutely just far exceeding what analysts expected. Just think about if one of your kids consistently brought home C's on their report card and they come home with a 99 on their exam. Like, you're ecstatic. That's what we're having right now, is that the companies are delivering A plus results. And the market was looking for, a B plus or an A minus. They expected a lot, but the companies have delivered and exceeded expectations. I gotta skip that, but the markets. We always say they don't die of old age. They're usually, there's an old expression. Art Cash was a floor trader for PaineWebber back in the day. He said they're killed by the Federal Reserve. So this is one of the reasons that we really want to make sure that we want to focus on them, that they don't go on a big rate hiking campaign. Um, Commodity prices. What's interesting to me is that 2026 is the year the gold bugs should have had their best year ever. We're having a war. This is exciting. Gold typically would go up a lot, but it was interesting. Kind of the end of January, we saw right at the end of January there was a big drop in gold, silver, and platinum. So they've been okay this year, but not kind of as good as you would expect given the global chaos that we have. Over this goes back 10 years, and uh, you see there's pretty good return. Actually, I'm sorry, it goes back 5 years. Pretty good return for silver, for gold. I think it's been interesting. Like, platinum is underperformed relative to the other ones. And as a matter of fact, you know, gold prices are higher than platinum prices, which for any jewelry buyers out there, that's kind of unusual. But then you look at, everybody talks about the bubble that the Magnificent Seven stocks have had. They had a return lower than gold has had. So I'm not sure that we can really classify that as a bubble. And the reality is that we know how to value stocks, right? How much money are they making? How much are their earnings growing? What's their balance sheet look like? Anything that has a cash flow, we can put a value on it. The reality is that the commodities, there's no cash flow. What does a bar of gold earn? It's not working, right? It's not earning anything. So, how's the price set? The intersection of buyers and sellers. When you have more buyers, it goes up. When you have more sellers, it goes down. That's a very different investment than buying a company where you can put a value on it based upon earnings. Not saying it's good or bad. It's different. It's different, right? Declining dollar. It's interesting. So the positives are that companies that have a lot of overseas sales make more money when the dollar's down. When they convert their sales back from the euro or the yen or whatever into U.S. dollars, if the dollar's gone down, they actually get a bump from that. Makes our exports cheaper. We've seen that with the trade balance. It's a tailwind for international stocks. We saw international stocks do better than the U.S. last year, and they're actually doing pretty well relative to the U.S. this year as well. Negative is that imports are more expensive, and if you're trying to travel overseas, hopefully you locked in your currency translation because it's going to cost you a little bit more, and it's more of a confidence thing. But again, this is another part of the gold bug story. The dollar is worthless, all of this stuff. Well, here's a 10-year chart on the dollar. It's up 4%. The S&P 500 is up 328%. So it doesn't appear that the dollar disrupted companies' ability to make more money and have their stock prices go up. Go back to 1990. the dollar's down 4.4%, and the S&P 500 is up 4,370%. Right? So the correlation, and you look at interest rates haven't really changed over that time period. So, all of the story of the government debt driving our interest rates through the roof and our stock market to nothing and the dollar down just haven't really played out at all. What areas of the market are interesting? Well, international is still cheap relative to the US. And it typically is, but if you go back in time, this was a more normal pattern. Like this is the PE ratio for the US versus international. It's usually kind of a tighter premium. What we've seen here is like it exploded, right? The US stocks are a fair amount more expensive than international to the point where, you need to make sure you're thinking about including those in your portfolio. We're not saying you want to go all international. That's always a bad idea, but you want to be diversified and have some of these companies that have lower valuations and still might have pretty good earnings growth. When you look at the S&P 500, relative to mid cap and small cap companies, there's a big valuation differential. So we want to make sure we have diversification, include mid-size and smaller companies as well in the portfolio. And the reason, buying something because it's cheap is a bad idea. Right? You need to have a catalyst to make it not want to be cheap anymore. So as everybody knows, like for a while, the big companies were the only thing that worked. The S&P 500. Now, this red line down here is the S&P 500 growth rate. And you can see, that trajectory versus small, the earnings weren't growing, right? So that's why the large companies did so much better. But look what's happening now, right? You've had an inflection point where small earnings and large earnings and mid-size are all moving up. So now I think you could expect the differential in performance to be a little bit closer and smaller, and we've seen that already. Small cap stocks have actually started to keep up with, if not outpace, some of the S&P 500. A lot of stories about the K-shaped recovery. This is the best one. So the consumer sentiment has been around, the survey's been around since 1950, right? Right. We just printed the lowest consumer sentiment number in the history of the index since 1950. Now, anybody who knows anything about history or was on the planet during these time periods, 1950 to 53 was a Korean War. You can pick whatever start date you want for Vietnam that ended in, roughly in 75. The 70s were a horrible decade overall, like just overall bad decade. And so what these people are answering the survey are saying, this is the worst time we've ever had. And I think that is a little overly pessimistic. And I credit the media for helping make everybody miserable, right? Because the reality is there's no way that right now is worse than 1974. Not
I was born in 74. It
That's
was
what
a great year.
yeah, and cars had catalytic converters and people were wearing polyester. It was not a good time. Leisure suits were around, Adam.
I think I was brought home in a leisure suit from the hospital. It was great.
So, but people are saying one thing and they're doing another. This is the U.S. economy is almost $32 trillion. This is where all the sentiment numbers were so bad. But look at what happened to the economy. It's exploding higher. Here's consumer spending. We're two-thirds of the economy. If we're so miserable, why are we spending so much money? Like, it's amazing, right? So, actions speak louder than words. The reality is people are grumpy. They might not like what's happening, but they continue to live their lives. Here's year over year spending. We hear all the time the there's a K-shaped recovery. The poor people, people aren't making much money, aren't able to spend that much money. But here's the lowest third spending on credit cards and debit cards by income. Lowest third income. Here's the highest. What's got a higher increase rate? It's the lowest, right? You say, oh, but that's credit cards and debit cards, so they're racking up credit and debt. And the reality is they're not. This is overall spending, which includes cash. And who's the leader? Those people that are making under 40,000. They clearly do not live in New Jersey or Long Island because you have zero to spend after you turn your lights on. But the reality is, when we look at it overall, the consumer continues to spend. You say, well, it must be a ton of debt here. This is debt payments as a percentage of income, right? So, all right, how much does it cost me to pay my mortgage, my car payment, my all my credit card debt outstanding? Has it gone up from the bottom? This bottom was artificial because the stimulus checks, people paid down debt. And where are we now? Arguably pretty much an average level of debt service as a percentage of income. And here's a look at what mortgages are and credit cards. There's no discernible trend here. So the narrative and all that stuff seems more of just that, a narrative as opposed to fact. Midterm elections, markets don't like midterm elections. This is looking at 120 plus years of data. This year is a midterm election year. Generally, the pattern that you have is that you kind of peak out in the late spring and then kind of bottom out. The market will bounce around, and then before the election, sort of you call it August, September time period, the market starts to go up and start the next big move up, which is into the third year of the election term. So, I'm not saying the market needs to follow this pattern, but I would just be prepared for a little, turbulence on our flight. I don't think it's going to be anything dramatic because the companies are making a lot of money. If you go back in time, these are all the midterm election years going back, and you can see overall the market has from the high the year before to the low of the midterm election years about a 20% pullback. It is heavily skewed by some bad time periods where we were already in a recession. The 30s minus 55%, and the year before Adam was born down 44%. It came back right after Adam was born, but um, so you have choppiness, but then look at the recovery that you have from that low in the midterm election year to the high then in the next year out. You're up of 45-ish%. So pretty good recovery off of some choppiness. Again, the market doesn't have to follow the same pattern. Is now a good time to invest? If you look at just the last 3 years and say, okay, last year the S&P was up without dividends reinvested up 16%. If you missed the 10 best days, there's about 250 trading days in a year. If you missed 10 of those, you were down 12 instead of being up 16. 2024, 23%, you were up 4 if you missed the 10 best days. And similar for 2023. So if your crystal ball is good enough to know which are the 10 best years, I don't know, by the 10 best days, let me know. But look at when these things happen. April 9th, that was in the middle of the tariff turmoil, right? And if you go back longer term, the 10 best days often 10 best days in history tend to be right in the middle of the financial crisis. Right. So it always happens when things are dicey out there, and then if you're on the sideline, you miss it. And the cumulative effect of that, this goes this goes back to June of 2000. The cumulative effect of that was, if you stayed invested, you were up 8% over this time period. If you missed 10 days out of this, these are 9,100 trading days, about pretty close to what we're talking about. If you missed 10 days, now you're up 4.5%. Missed 20, you're up 2.2%. You only had to miss 40 of the best days to be down. This speaks to sticking to your long-term plan and not getting too emotional about what stocks are doing in the short run. And the reality is we're just bad at getting it right. Right. So this is the American Association of Individual Investors. They do a weekly survey and ask people if the market will be up or down in 6 months. Right. This is when most of the people responding thought the market was going to be down. When did the market bottom? March 30th. Right about when everybody was the most negative. And then it took off. Right. So the reality is that typically people are feeling bad about the market at exactly the time they should be thinking about buying the market for their longer term plans. The other thing is you got to stay focused. What's the purpose of the money? This money is your long term. You're going to create this flow of distributions, or it's for your kids or your grandkids. What's happening in the short run of the market's somewhat irrelevant, right? The reality is you want to be focused on, when do you need this money? Not when you need to take a portion of it, when you need all of it. Like if you're going to need all of this money in a year, you shouldn't be in the stock market. right? The period, right? That's why you think about short-term money, intermediate-term money, and long-term money. But over time, focus on high quality stuff. Don't just chase what sounds like the highest return. Focus on high quality and be diversified. That's how you grow assets prudently over time. And then bonds are offering a return that we haven't seen in a while, right? Bond interest rates are higher, so could be part of the portfolio, not just to play defense, but to play a little offense too. And then lastly, my public service announcement: turn off your TV. It's the best investment advice I can give you. You will have lower blood pressure. You will be happier. And the reality is that their motive is to get you to watch more of it. They do it by getting you to be focused on the breaking news and, yeah, I can't turn off the TV because there's something really important happening. The reality is it probably isn't that important. And you'll be better off if you go do some gardening and not be terrified by the TV. Ask yourself this: when's the last time you watched, particularly the political channels? And I'll watch all of them just to hear to see what's going on. When's the last time you watched 10 or 15 minutes of a political channel and said, I can't take any more good news. I feel too good right now. I really should turn off the TV because I'm so happy. It doesn't happen, right? It's just constant bad news or terrifying news or some combination that's not giving you good investment advice. Jill and Adam give you good investment advice. So
Still does.
I'm going to stop
I was
talking.
born. I was born in 1974, so I'm still trying to recover. So
All right. So you can chat in questions if you would like. Should be a chat button on the bottom of your screen. You can certainly communicate with Jill or Adam as well if you want to
I've,
ask anything.
I've been watching my emails. I haven't seen anything on my emails or any other things yet. Jill, do you have anything that came in yet?
I don't, but I have a question that I get constantly asked, which is what's going to happen with the S&P by the end of the year? What's the goal? We're not going to hold you to it. We'll pretend we're not, recording this for future viewership, but what is Clark thinking?
So we put out a forecast at the beginning of the year. We said 7,700 on the S&P, which at the beginning of the year everybody thought was very high. We we suggested we probably would have a good early start to the year, maybe a little choppiness in the middle of the year, and end on a strong note. What's interesting is that the people that were very nervous, when I say people, I mean other investment houses that put out forecasts, have several of them have raised their forecast now to 8,250 on the S&P. We haven't done that, but we have a sneaking suspicion 7,700 could very well be wrong. If the earnings continue to grow at 20% year over year for the next 3 quarters, like they're forecast to do, 7,700 will be low. It will not be a straight line, right? You will have our 5% pullbacks in the market. They happen with regularity. Maybe we have a 10% pullback in the market. But if our earnings going to keep growing 20% a year and the stock prices go down, that makes us really excited because now we're able to buy a company that's growing their earnings and going to make more money at a cheaper price.
We got a question coming in. This is a stock specific question. So a stock specific question with Clark. I know that you can't, but it's an IPO question. So it's about SpaceX. And obviously, Elon Musk has been all over the news politically and personally. I remember a couple of years ago, he was the darling of one side, then he was the bane of another side, and then it's flipped back and forth. He's saving the world, he's killing the world, he's killing everything, he's killing jobs. But now SpaceX he's going to IPO SpaceX, or it is IPOing. Should we buy it?
I always hesitate to give recommendations on
Right.
specific stocks or not, right? So
okay, maybe let me frame the question because I know that you can't.
I'll
Yeah.
answer it. I'll answer it like a politician.
Okay.
So I'm a big fan of thematic things over time. Right? Over time, if you're in, we're all getting older, so we're going to need medical parts over time. We're going to need glasses, we're going to need hearing aids, we're going to need hip replacements. Those are thematic type things. Space is a thematic type thing, right? I can't speak to the valuation of the IPO. I think they're losing money, right? So it's hard to put a value. it's hard to say, oh, it's cheaper or it's not because there's no actual positive earnings that I'm aware of to compare the value of. So I think from a thematic standpoint, space is very exciting. I think that all the data warehouse build, a lot of that stuff is probably going to end up in space because it solves the not in my backyard problem because the Martians aren't complaining about a data warehouse, the best I know, and it's easier to cool, right? Or generate electricity, right? So you're able to get unlimited solar power in space because it's not cloudy in space, right? So there's some interesting ideas. And from a telecommunications standpoint, I mean, I can't get a signal on my cell phone on the 53rd floor at One Liberty in Philadelphia consistently. That drives me crazy, right? So would I consider getting a Starlink package at some point as a backup to Verizon? Or I'm no there are no endorsements of any products, blah blah blah, or endorsements to buy or sell. But would I consider doing that so that I had ubiquitous coverage? Absolutely. Do you have satellite radio in your car? I do. I love it. I listen to it all the time. I don't even listen to regular FM radio anymore. That seems to make sense to me thematically. Unless you know Elon Musk, you probably are going to have trouble getting shares before the deal comes public. Um, it's highly likely the deal is very oversubscribed, meaning, and I'll just take numbers. Let's say if they're issuing 1 million shares, there's going to be demand for 5 or 10 million shares. So whatever you try to get in if a brokerage count, if you get any, if you're a top client, it's going to be a small fraction of what you want. There are some sidecar plays to try to get there. There are some ETFs that theoretically have, and I've not really done any homework on these, that theoretically own it kind of before IPO at the private level, that so you could buy the ETF and theoretically have some exposure to it before it comes public. I'm not suggesting you do that. I'm just telling you what's kind of out there as possibilities.
So thinking about the thematic, thank you for your answer. I get it, and we can't make that one specific recommendation on a stock, but from a theme standpoint, down here in Florida, which I'm still in Florida, we'll be back in New Jersey on June 5th or 6th. But at night, we can actually we watch SpaceX rockets go off all the time, and I'm on the West Coast. We see it go over. It's pretty cool. Like 3 to 5 times a week, we're seeing rockets going up, and then we're seeing boosters coming down. It's amazing.
We can see them, believe it or not, in Long Island. You'll see a chain of them. I thought it was UFOs at first. You'll see a chain of these lights that's moving through this. I'm like, oh my gosh, what we're being invaded. And it turns out that that's exactly what it is. It's they're satellites.
It's amazing seeing them being launched here. And then Starlink, we actually have because in New Jersey, going back to cell phone reception at the beach, in we can't get access. Well, what did we do? We bought Starlink. Now we
Yeah.
can work from the beach. Now we can
Right.
actually have access to the beach. So it really it is one of those things where we're moving around. We're global. Why not invest in that? So something that you probably can speak about. Tesla as a security, I mean, it's in and out of the portfolios from time to time. It's a good holding, but that company has been argued that it's really not making money either, correct?
Correct.
But look at the value of Tesla.
Yeah, it's less about their cars than SpaceX and things like that, right? And it's more about the technology.
Yeah, and it's amazing, and so it's great. Let's see if there's any other questions. Jill, did anything come in on your end?
So no, but again, I'll go through what I usually get asked. Gold and silver. So I know we touched on it. And you, Glenn, you and I have talked about this and a slight comparison to crypto. There's still such a request to have a portion of that, the commodities in the portfolio. Why? What is it? Is it the thought or the emotion that it's safe? I mean, as you said, we can't go to our local Target and drop a brick of gold and say, here, let's buy the items. But yet there's more and more, whether it's the news that we already talked about that we shouldn't be listening to, but there's so many articles that are out about adding these to your portfolios. So we don't want to argue with our clients. We want to make it a diversified portfolio. But I've had a client who's like, I want 100% in gold and silver. And I was like, I will document that, but that's not a good decision. Just as we wouldn't put everything in Tesla, we wouldn't put everything in Facebook. So thoughts about percentage of diversification to commodities?
I think in general, when we talk about alternative assets, whether they're the commodities, gold, silver, platinum, whether it's, you know, artwork or digital currencies, 5% is kind of a number that goes out there as a kind of a middle ground. Some people push it up to 10%. I get a little nervous about that. Um, Gold has historically been the world's coming to an end asset, and I want gold. Honestly, world's coming to an end. I don't want to be pushing around a wheelbarrow full of gold bars. I want water, food, and guns. Right? So there's a mystique around it, but the reality is that could change. Right? Look, gold prices are worth more than platinum now. Why is that? Because retail investors are buying gold and pushing gold prices up more than platinum because that's what they're hearing on TV, right? Platinum's always traded above gold.
Correct.
And that, when I watch that and I watch the flows into the gold ETFs, that's a lot of retail money coming into an asset class because it's been doing well recently.
Right.
That always scares me in general. So again, I'm not saying it's a good or a bad investment. I mean, it could go a ton higher, but that's always a warning signs that you got to be a little bit careful. So don't go all in or 100% on something. That's what did I say about timing? It's like focus on quality and stay diversified. That's how we're not in this to try to hit the grand slam. Like if we're in this to score runs over time, and sometimes that's getting a walk or a single or a double. It's not having to win the home run derby.
Makes sense. I had a whole litany of questions that I was prepped beforehand, and I honestly say, and this is kudos to you, Glenn, and this conversation. There's not another question I can pull out of my 3 pages of questions that haven't been covered. We'll give it one more minute, but while if something comes in, we'll jump on it. But I just wanted to say again, thank you for all our clients to jumping on. We will get this is recorded, and we will get this through compliance and then post it on our website so you can rewatch it. We'll send it to clients that weren't able to meet here today. And Glenn, thank you always for your comments. Thank you for your partnership, and thank you for kind of giving it to us straight. We're always waiting for that, and it's always welcome to have that. So thank you. Oh, something comes in last second. Would you only take 10% of any asset?
No.
Well, would you only take 10% of any asset?
So if I look at the asset class, the major asset class is stocks, bonds, cash, right? So if you want growth in your portfolio and you want to outpace inflation, you're going to need a good chunk in stocks, right? Because they're growing their earnings. Think about it. Companies that are selling goods, they're raising their prices, so there's some protection against inflation by owning stocks, believe it or not. Right. So if you look at a typical endowment or foundation, I would say ultimately we're all kind of like any of the universities that have an endowment. We want to be able to create an income stream, 3, 4, 5% of our assets forever, and not run out of money, right? Not deplete our principal down to zero. So what do those endowments and foundations asset allocations look like? They're typically 50, 60, 70% stock, and then some chunk in bonds. And they're because they have an unlimited time horizon that they'll have some more private assets in there, right? Some things that don't have as much liquidity. But ultimately, they're all about a 60-40, 70-30 stock bond ratio what's their goal? I want to be able to generate 3, 4, 5% to take out, not just in form of income, but capital gains too, and have that continue to grow. And there's hundreds of years worth of data that suggests that's a kind of a normal-ish allocation. There's no one size fits all. right? It's really, really important to know who you are, what volatility you can stomach, what your cash needs are going to be. That's going to ultimately dictate how much you should have in any one asset class. And that's where Jill and Adam and their crew come in to be able to help you navigate that. But yeah, so the reason 10% is kind of a max level, and again, I would probably prefer 5%, is these are non-traditional assets. They don't have cash flow, they don't have earnings. So they're meant to primarily to offset the volatility of stocks, meaning the returns are not linked to the stock market, right? That's why they call them alternative assets. And that's why we sort of put a limit on it.
And they're alternatives to the stock market. They're diversified against the stock market. They're inflation hedges. They're however you want to look at it. They're buffers in a portfolio during markets. But it's interesting having a conversation. This is from a planning standpoint. Again, I think Glenn, you were talking about the plan. You zoom out, and we were working with a client, and I'm not going to go into specific details. One, but just kind of and I know him very, very well. He wouldn't be he'd be okay if I shared the framework, but I'll still change it a little bit. Long story short, big liquidity event, sold company about 8, 9 years ago. Now diversified the portfolio, put money in the market, put money into some private equity pieces and invested, diversified some money into some individual companies, bought some real estate, basically diversified to diversify. Um, what's the best rate of return was the question I asked. Which one gave you the least amount of stress, and which one actually returned the most? And it was the market all day long. It was the market. It wasn't as sexy. You weren't going to have those years where you had like a 40% return on the money, like maybe you can get in a private equity when something pops. But he also wasn't chasing down people to pay him rent for warehouses that were bought and companies that didn't take off. So the market is not perfect, but the market is predictable. And everything that Glenn said before, it's not gambling. There's what are we doing? We're buying into companies underneath the hood. We know they're reporting every quarter. We know exactly what's going on in the company. We know what their cash flow is. We know what their leadership is. We know what their projections are, and we make logical investments into those companies, projecting what they're going to be in 90 days, 180 days, 365 days later, and moving outward. That's how stocks are picked. And if we can get stocks lower than the price, and they're going to grow, and we put a whole basket of them around it and diversifying it through different industries and in different segments, that's a diversified portfolio that over time beats almost everything else. Or no, it ends up beating. Glenn, check my math. Check because you have all the history there. Is there a sector or asset class that's outpaced the market over the last 100 years?
It's consistently, and I mean, uh, yes, if you were, you're gonna have to take way more risk and you have way more volatility, right? So you could probably look at private equity returns. Longer term is probably higher than the S&P 500, I would think. Um, but not always, right? It depends when you get in. That's
And
what
the access to it, and the access to that is also very limited.
the,
And the liquidity of that's very limited.
exactly, and that's why it's typically and the numbers that are quoted aren't what you would buy in real life primarily, right? These are private partnerships that the big endowments and foundations can invest in, and then they show those numbers. Everybody's like, "Oh, I want some of that." Well, great. If you were Harvard, you could get it, but the reality is you can't. I mean, to be I mean, you think about it, you get a situation where somebody has a liquidity event and they're like, "Oh, should I put the money in the market, or is it too risky?" They went from a single private company to cash in their hands in many cases, the business owners. Now we're going to become an owner of 140, 150 well-established companies and very small percentages, what's riskier? A single private company or a diversified portfolio of high-quality companies that have a good track record? That seems like it, but this is a conversation that we have on a regular basis. But they're like, well, but I'm in control of my company, so that's a different thing. Like that's a control issue. That's a you issue. That's not a truly financial issue. That's not a numbers issue.
Mm-hmm. Absolutely. Great conversation, and it's try to simplify this the market to people is sometimes that's what we do. And quite honestly, when Jill and I and the Forefront team talk to clients, that's why we always spend more time on the planning, the purpose of the money, your purpose, your life's purpose. What do you want to accomplish? Because the rate of return is not what we want you to judge our value on. Because guess what? The rate of return is table stakes for us. We have to give you guys great rate of return. But the great rate of return has to be commensurate to the risk you want to take, the allocation you want to take, and how the overall plan is. If we're working with you and you need a lot of money in cash because of liquidity issues, cash flow issues, whatever, your rate of return is going to be cash rate of return. But we're doing the right planning for you. And as we move further out, then we can be looking at market rates of return. So it all starts with the plan. And then when the plan all comes together, kind of like Hannibal and the A-Team, once the plan comes together, then we diversify the portfolio. Yes, I was born in 1974.
Did I really just hear an A-Team reference? Just want to make sure I caught that right.
Well, you did, and Jill's gonna do B.A. Baracus, and we'll have a good conversation about that. So I've lost half the people on the call, but that's okay. But we're having fun. Good, Jill. You can wrap it up and wish everyone a great Memorial Day weekend.
Well, you just said it, so now I can't say no. Thank you all for attending. Again, as Adam said, we will post this once it goes through our compliance, but it'll be on our YouTube channel. Glenn, as always, thank you for the time and the partnership. And for everyone on the call, if you're still there, you have additional questions, reach out to Adam, myself, or anyone on the team, and we'll be glad to answer them if you were too shy to do this on the webinar. So have a happy holiday weekend. Hopefully it stays warm and not raining.
All right. Be well, guys. Take care.
Bye.